Hello everyone and welcome to today's major markets update. It is 1:30 p.m. Pacific Standard Time, a sit on your hands environment. Yes, that's pretty much where we're in because we have not really confirmed much, if anything at all. Remember, we are tracking several setups that need to materialize, and if they don't, we simply have to step through another door. That is the beauty of Elliott Wave. This is a quote from the Wall Street Journal about the book Elliott Wave Principle by Frost and Prechter. And it really states that it is the best forecasting tool in existence. That is hands down, I fully agree. But the Wave Principle is not primarily a forecasting tool, all right? It is really, truly, actually a description of how markets behave, how investors behave. You're tracking mass sentiment. So that description does impart an immense amount of knowledge about the market's position within the behavioral continuum and therefore about its probable ensuing path. Remember, we're tracking continuously the possibilities and the probabilities and what the probabilities of those possibilities are. As I continue to say, when we step through a door, two more doors await us. We step through the next door, two more doors await us, sometimes three, sometimes four. That is the market that we try to elucidate which of these doors the market is going to take. Impulses are quite straightforward. Corrections are absolutely not straightforward because of the ABC overlapping nature of the market. And that is really a litmus test separating the men from the boys. And they're really, really hard to trade, therefore, if you use the Elliott Wave Principle as well in trying to understand what the market is doing. So the primary value of the Elliott Wave Principle, it provides a context for market analysis. That's why we use market breadth, technical analysis, sentiment, those type of things as well. Because this context then provides a basis for a disciplined thinking and a perspective on the market's general position and outlook. One has to continuously repeat the same process over and over again. After 5 waves up, expect 3 waves lower. On any time frame, doesn't matter if it's years, decades, or minutes and seconds. After 3 waves lower, expect at the minimum 3 waves back up. Why? Because the correction can subdivide from a zigzag, 3 waves lower, to, for example, a flat, 3 waves lower, 3 waves up, 5 waves lower. You don't know beforehand. Now, if it's a 4th wave, most of the time it's a flat, but you always have to keep an open mind. That is the beauty of the Elliott Wave. You already know what's going to come most likely next, all right? So in that sense, pigs will never get slaughtered because you have your beautiful if-then scenarios. At times, this accuracy in identifying and even anticipating the next directional move is unbelievable, right? You can really do fantastic target zone forecasting. So many areas of mass human activity display the wave principle. Unfortunately, the Elliott Wave Principle is not accepted within, for example, psychology and sociology especially. Which is a little sad. It's a little bit of the where you say, we dismiss what we don't understand. However, it is, of course, a very popular used tool in the stock market. So I really wanted to put it out there because currently the market is in a rut, meaning we have not much confirmation of anything. Remember, these were then the parameters to look for. These are based on Elliott Wave and based on technical analysis. Tracking for 5 waves up hasn't completed yet. All right, the initial pattern of a 1-2, 1-2 was in place, and we then needed to complete 3-4, 3-4, and 5. So far, I'm only down to gray 4. I haven't seen gray 5 yet. Okay, that's still not the end of the world for higher prices. We can, for example, ABC our way higher as a diagonal or simply a corrective price structure that is a larger bounce. But just that opens a whole new can of worms. So we don't have this higher high, higher lows, 3, 4, 3, 4, 5 in place. We're stuck at 4. Did we break above last week's high? Yes. Did that resistance, which was last week's high, turn into support? No, it didn't, because we're below it again. So there we once again fail. So we set these parameters, and then we know if these parameters continues to be checked off, it's great. If we don't, then that's not great. Super easy. I mean, it doesn't get any easier than this. While everybody's screaming, chicken-lickling, and having opinions about I don't know what, these were the parameters we're looking for. So that brings me to the Dow Jones. So the Dow Jones broke last Friday above this green wave 4. It topped, as you can see, exactly in this gray 3C target zone. And this is where we have question mark 4 and question mark 5, because after 3 waves up, we ideally want to see 5 waves higher, ideally following this standard Fibonacci-based impulse pattern. The market reserves the right to not do it. It can turn it into a diagonal where 4 and 1 overlap. Now, diagonals are highly unreliable price patterns, cannot be known beforehand. It takes about 75% of the price action before we know it. Now, if we get blast off tomorrow, based on the CPA report, which is going to hold the market hostage, I think it's the reaction of the market to this report, we'll get a nice resolution to the current price action. So we topped right in wave 3. This is your target zone for short-term traders. This is where you take your profits, raise your stops, and all that good stuff. If you use the Elliott Wave, we've now reached target zone 4. You could, for example, go long, set tight stops, all those things, or one says, you know what, this CPA report is the wild card. I'm not going to bet on anything. I'm out, and this is from a short-term perspective. Again, exiting and entering the markets really depends on your time frame. Are you in it for the next 2 decades, 20, 30 years from now? It's entirely different than if you're in it for only 10, 20 minutes. All right, so please always keep that in mind. What I don't like is that we broke below this wave 4. It's a little more obvious for other indexes, target zone. So that already puts a little bit of a question mark on, is this all of wave C? If it's not, and we get a negative reaction to the CPE tomorrow or over the next few days, then we have another resolution to the price action. All right. Remember, after 5 waves lower, expect at the minimum 3 waves back up. So we had clearly, this is the Dow Jones, by the way, on a closing basis chart, 5 waves lower. 1, 2, 3, 4, 5. It's loud and clear for everybody to see. That could then have completed wave 5 of C of 4. But again, the market reserves the right, and especially in corrections, to continue to subdivide till it's finally done. Please remember, this is still an utterly weak market. We're below the 200-day, 50-day, 10, 20, you name it. Everything is weak, so don't expect great things. This is an entirely different market environment on the left-hand side of your screen versus the current market environment. So if we're going to plunge lower and we're going to plunge below the mid-June low, then the resolution is as follows. Then we have not a wave 1, a 2, but we have a smaller 1, a smaller 2, a smaller 3, a smaller 4, and that then completes wave A, okay, instead of wave 5. And then we have wave B here at last week's high or this week's high, whatever it is. And we're now in another wave C. And this is what I mean with corrections. They can continue to slap on another ABC. That's why we have these parameters in place. We need to see these checked off. If we don't, then the market will continue to subdivide. So this is why I say this is still not a slam dunk environment. Not at all. We haven't even met the initial pattern for a impulse to the upside, not at all. So if you're in it, I would say for a little bit longer, so to say, this is as questionable as it gets. So we need to, of course, see follow through. We need to, of course, to see all those checks being checked off. And it hasn't, so then the market reserves the right to continue to subdivide lower. But we have beautiful if-then scenarios. That's what we have, because if we break lower, then we know we're going to head to lower prices, not an impulse, all that good stuff. Here is then the Nasdaq 100. I've revised the entire wave count since March. This is what I do on my off day, review every single chart, besides a lot of other things, to see what matches best. And it's all, in my humble opinion, ABCs. This just looks ugly. I find it hard to count this as an impulse, especially here, this mid-April mess. This mess, everything is ABCs with internals being 5 waves. The C waves and the A waves are 5 waves. Then we had another 5 waves lower. Alternatively, this week's high was 4 and we get a 5. Okay, that is still a possibility. We'll know it eventually. If we break higher, then we can target 15,000 plus on the Nasdaq. Because remember, we had this wedge or diagonal pattern here in January through March. When a wedge completes, the retrace will be fast and furious back to the start of the wedge. Now we have an even bigger wedge here in black. If we break out, We'll know soon enough over the next few days if that's going to be the case or not. Then the retrace will probably be fast and furious. Not as fast as the diagonal that formed previously, because of course this is a much larger diagonal. So it is all relative, right? So if you have a diagonal over 3 months, then a 2-3 week rally is of course fast and furious. Whereas if you have a diagonal that has lasted for 6 months, expect a multi-month rally. Doesn't have to go all the way back here, but that is the technical principle that we're looking for. There's going to be a lot of resistance in between here and there. So please keep that in mind. This is the condition. So we have the condition in place. Now we need to wait for the trigger. The trigger will be the breakout, just like we had here in March. Once we have the breakout, then we have a very nice setup in whatever exact way it's going to get there to potentially get there. So we have the potential, not yet the trigger. Positive divergence galore, but we need to see price react. Haven't seen it yet. If we don't get a breakout, we continue lower. I'm expecting about 10,050 plus or minus 500 for this alternative wave 5. Please keep that in mind. Semiconductors, I haven't shown this chart in a while, but so far I haven't changed much of a thing here, in that the recent high here was most likely wave 4, and we should now be in this wave 5. That's the ideal premise for this wave count. So far, so good. Moving on to the S&P 500. Also here you can clearly see how this week we tagged exactly 161.8% extension. I think we were off by 7 points, and we declined. So we have a nice 1, 2, 3, 4, 5 waves up from the previous low. So that's the impulse, but it can be wave C. That's why we label it as A, B, and C. Target zone reached, raise stops, take profits. Then we said we have to hold, of course, last week's high. We didn't. We've broken below it. So that's already a warning sign. That was 2, break above this resistance level, stay above it, and then break above the June highs. And of course, we need to stay above the low here. Well, already broke below it. I don't like it. Technically, we can still try to move higher for this wave 1A. Alternatively, this is then A, and this is B, and another C wave. This is what I mean. This rally has completed. I'm quite certain of it. Okay. Then we have the potential for this ABC. The only other way I can resolve this is then as this alternative 4 showing for the Nasdaq 100. It's a possibility that this is a 4 and we get another 5 down to 34.95. We really need to see how the market is going to react over the next several days. We get the breakout, then I'm going to start looking for about 4,000 for this wave 5. If we get a breakdown, I'm going to look for 34.95. That's really where we currently are. The market has not made it any easier. Yesterday definitely was making things much more complicated than it ideally should have. You can see the 161.8% extension is the 34.95. That should then be wave 5 of CO4, with, of course, again, the reservation that things can subdivide continuously lower. They really can. And that's when we start looking again for the next parameters to suggest that a low is in place. Okay, so I need to see those parameters when we go lower once again. We need to see the impulse, etc., etc. So to recap, the decline yesterday definitely went further than it should have for this potential wave 4. It opens a can of worms that it can drop below 30 to 34.95, or it can drop to 10,500 plus minus 500 for the Nasdaq 100, and the Dow Jones as well can still move lower. We had clear 5 waves lower. That's why we put a question mark. Did all of this potential wave 4 complete, yes or no? Now we only have 3 waves up so far. It can still turn it into 5 waves up. We'll know soon enough. If it's 5 waves up, that would make my life much easier, because then we have completed wave 1A. We'll see another pullback for 2B, and then etc. Okay, then we get at least 3C. Then we get a much larger bounce. Now, this morning I saw a nice tweet by Avi Gilbert about trying to make sense of this mess. So he's also getting in a pickle. So I read the article and I want to share it with you. And that's pretty much the same as I'm seeing here. We're either for, or we're going to complex ourselves into something, an ABC, etc., etc. So there are many options now on the table. Lastly, I wanted to point out is that Avi is now shifting gears as well, and that we've potentially only completed, I would say this is then major 1 of primary 5. So the bullishness is now started as an alt count to diminish for him as well. And maybe eventually he'll turn to the fact that maybe all of primary 5 is completed and that we are now in this super cycle 4 wave. To be determined, but again, just wanted to show you also here that he is now trying to make sense of the current mess we're in. And that's why I say, not only because of him, but what I'm seeing is we have to sit on our hands. Nothing's been confirmed. All right, this can still go higher, but I need to see at the minimum breakout above yesterday's high. We should not fall any lower. And again, I think the market is held hostage by the CPE report on inflation, I believe, right? Tomorrow, and how we are going to react to it will give us hopefully more clues on if the dominant direction is to the upside, be it potentially overlapping messy ABCs, or if we are going to see a further low. That's why I also want to point out that we have, of course, these patterns on the charts, right? We have these large diagonals. The same can be seen here, by the way, for the S&P 500. So we don't want to hold ourselves only hostage to, let's see if I can find it, to Elliott Wave. Again, there's too many options sometimes available. Let's see if I can here. Also here, we have this potential diagonal path for the S&P 500. So we also need to recognize patterns. Just as we had here January, February, March, it targeted exactly the breakout or the start of the diagonal. We can see the same here. If we break out, we can target 43.65, 45.30. So this is the ideal target zone. Okay, this is the condition, and now we need to see if the market reacts. But please remember the bearish scenario, the market is in because price is below the 200-day to 20-day moving average. We're only above the 10-day, so there's really not much great in the chart just yet. Breakout above this diagonal path, and I'm going to look for 4,300 to 4,500. And then the market can decide if that is then again the start of major 5 to 5,500, 5,000 to be determined, or only a bounce. Because remember, we're still then determining if we have a wave 5 on our hands. We do need to break above, of course, the March highs, or if we are in a bounce. Okay, those two options remain still on the table. Cannot discern between the two. The longer this correction is going to take, and of course the further we're going to drop, the more likely this super cycle 4 scenario is. Okay, don't really like the idea that this is only wave 1 of 5. I don't like it. But to be determined. So with that, I hope you get an idea of, I would say, the beauty of the Elliott wave, but also on where we currently are, and that the market needs to decide pretty quickly what it wants to do. So we have many options on the table, some of which I might not even have presented here because I don't want to present 50,000 different options. But again, a break above yesterday's high gives us a nice clean 5 waves higher. A break above the trend lines that has held all the price upside in check since March is bullish, because then we have this potential conditional wedge formation complete, and that means we're going to start a rally back to the start of the wedge, and that'd be fantastic. We can still tag on a little bit lower if we want to, so I think tomorrow will give us a good idea on exactly how things are going to transpire over the next few days to weeks. So please keep that in mind. This is a sit on your hands environment. Trade small if you want to trade it. For example, my trading alert service is only going long a quarter size position, meaning the risk is only a quarter of what it would be in a bull market. So if we get stopped out, the risk is tiny, very, very tiny. It means one could essentially do 400 losing trades in a row before one's entire portfolio is blown up. So that's really what I wanted to say. Trade accordingly. This is not a raging bull market, quite the contrary. Trade according to the time frame you're interested in. and keep your stops tight and make sure you listen to your stops at all times. Program them in and let the computer do the rest. With that, thank you so much for listening. Hopefully we get a nice resolution tomorrow. We break higher. I'm going to look for much higher prices. If we start breaking lower, overlapping, all that nasty stuff, I'm going to look for the lower prices. They're all on the charts, so you know exactly what to look for. So for now, sit on your hands, I would say. Let's see what the market does tomorrow and Friday, and hopefully we get a little better answer by Friday. Take care, trade safe, see you all on Friday.